Investing in Tesla for the long haul may easily net you a fortune, according to famous investor Ron Barron. With a 1% stake in Tesla Incorporated, Ron Barron predicted in 2016 that the company will become a global powerhouse. His investment firm, Barron Capital Management, was among the electric car maker's most prominent backers back then. A $4 billion profit was the result of the wager, but according to Barron, it's only the start. He predicts the profit may increase in the next decade. Could you tell me his investment strategy? For what reason is he so committed to the brand? Notable investor Ron Barron has maintained his position as one of Tesla's leading backers for many years. According to a recent interview Barron gave to CNBC, he intends to keep owning Tesla stock for at least another 8 years and thinks the company has a lot more potential to climb. If you're unfamiliar with Ron Barron, you're likely new to Tesla stock. His company, Barron Capital Management, was a major 2016 investor for Elon Musk, as we noted before. It held 1% of the Silicon Valley car. We invested $380 million, or 1.5% of our assets at the time, between 2014 and 2016, according to Barron. I anticipate a 3 or 4-fold increase in our current profit level over the next decade, from $4 billion to $6 billion. Elon Musk's electric vehicle startup was a first investment for Barron, and he reveals why. I was under the impression that the possibility of switching American-made cars from petrol to electric was within reach with Tesla. Barron Wealth. Long-term equity investment opportunities are the specialty of Barron's namesake investment firm, which he founded. In light of Tesla's meteoric rise over the past 3 years, the electric vehicle company is now worth over $6.2 billion, or about 12.8% of its total assets. Under the care of Barron Capital, a sum of $58.9 billion is maintained. Barron Wealth. During the years 2014 to 2016, Barron's eponymous firm spent almost $380 million, or little over $50 share, on Tesla. After investing $380 million in Tesla 7 or 8 years ago, Barron said that his clients were able to reap $54 billion in earnings. This figure includes around $6 billion from Tesla. Another Elon Musk venture, SpaceX, should do as well, in his opinion. He thinks the rocket firm might revolutionize the $1 trillion satellite broadband market by applying the same traits that made Tesla successful: a focus on cost reduction, a readiness to try new things in an industry that is locked in its ways. According to what Dan Barron said in an episode of Bloomberg Wealth with David Rubenstein, they're inventing at a light speed. With the cars, they're following suit. Even SpaceX is participating. Even though it was a sad but essential transaction for risk reduction, Barron sold 1.8 million Tesla shares for his firm's clients in March of this year. If you want to make money with Tesla, you have to be in it for the long haul, according to Barron. He doesn't seem ready to cash out just yet, though. He says it's better to hold than sell right now, even though he thinks he might sell Tesla shares to reduce his client's risk. Investors, in Barron's view, should ignore short-term setbacks like Tesla's most recent delivery mishap. Regardless of how the stock has been performing, he is correct that the company has been doing really well. Throughout the history of the automotive industry, no stock has been as volatile as Tesla Incorporated. Elon Musk, who is just as controversial as the company's founder, has taken it from a revolutionary business to a viral sensation. The electric vehicle manufacturer's stock price has just fallen in the first quarter of 2022, making it the perfect example of a corporation that the market claims is overvalued due to speculation. Stocks have been falling steadily due to concerns about inflation, interest rate hikes, and a potential war in Europe. But this trend wasn't exclusive to Tesla stock. Generally, the market was impacted hard, and yet Barron isn't worried about Tesla's stock price. He brought up the fact that the company expanded throughout the conversation, even though the stock price was relatively unchanged for a few years. Nonetheless, breakthroughs in technology and software, along with an uptick in production and deliveries, have led to a 5-fold increase in Tesla's share price thus far, all because of its self-driving infrastructure. The use of stock pickers is becoming increasingly obsolete as index funds and ETFs gain ground. An anomaly in these trying times is Barron Capital's performance as a provider of traditional mutual funds. According to Barron, his confidence in the company has always been solid. Even though he owns more than 1 million shares of Tesla stock, he insisted that his corporation would purchase more of his stock if he controlled the situation. We think the company is doing great, and that Barron's recommendations to ignore market sentiment and concentrate on the company's operations are wise. Several industry watchers still have faith in Tesla's ability to achieve its 2022 targets, despite the company's struggles thus far. Recent product improvements have led Barron to predict that the company's revenue, which is currently $35 billion, can grow at a rate of 50% annually over the next decade. As a result, car sales might reach approximately $750 million. Barron claims that Tesla plans to significantly boost production of its own battery cells in the next years, and that doesn't even consider the fact that the company is already making its own battery cells. Another fantastic sector of the economy that I'm very passionate about is batteries. In the next decade, your investment will grow fivefold at that valuation. It seems like experts can't agree on what will propel Tesla's expansion to new heights. Self-driving cars, the foundation of Tesla's success, have the potential to revolutionize transportation. Despite the recent success of Tesla's autopilot and full self-driving suites, analysts from Morgan Stanley are doubtful that these autonomous driving initiatives will sustain the growth and development of the company. However, the bank is putting its money on Tesla's strengths, which include making cars and other products, as well as its supply chain management, infrastructure development, and material sourcing capabilities. Despite Elon Musk's assurances since 2018 that Tesla will complete its exploration into fully autonomous vehicles, it is well known that the company's FSD and robotaxi aspirations have been unsuccessful. The introduction of a feature-complete FSD suite or the rollout of the planned robotaxi fleet have both been further delayed by the new set of barriers that have emerged each year, whether they are related to manufacturing or the availability of crucial parts. Because of this, some people doubt that the electric car company can sustain its enormous growth rate through just one channel, especially because Tesla has shown expertise in manufacturing in the past. In a recent note to investors, Adam Jonas of Morgan Stanley and other analysts argue that Tesla should stick to its strengths if it wants to continue growing and increasing its value. A 9-quarter run of increasing vehicle deliveries is a direct outcome of Tesla's recent efforts to increase manufacturing efficiency and precision. Despite concerns that the shutdown of Tesla's most productive factory in Shanghai could end that streak, the company's manufacturing capabilities seem to be the most promising avenue for future growth. No matter how you slice it, Tesla's success has been driven by its inventive traits and manufacturing prowess. Regardless of the competition, one thing is clear: Tesla can only go up. If you want to grow rich off of Tesla stock, the best course of action, says renowned investor Barron, is to be patient and hold on for the long haul. You risk losing a lot of money if you invest in Tesla stock, since it is too unpredictable to make a good profit in the short run. A large number of experts raised their target prices due to recent events, such as Tesla's new factories opening and the company's performance exceeding analysts' expectations at the most recent earnings call. Analysts deemed the upgrade warranted due to Tesla's competitive edge over original equipment manufacturers and the company's remarkable profit-making performance, even in the face of supply chain disruptions and reduced plant capacity. The company will undeniably become even more significant as it expands and introduces new items, surpassing its current position. Tesla is currently working quicker to achieve its targets, and the company has prioritized facility expansion because electric vehicle production and delivery are tightly tied to profit margins. Investing over the long haul, like Barron did, has a better chance of producing a fortune than betting on a company like Tesla, which is still in its early stages. Is Barron's strategy one you can get behind? Please leave a comment.